Ever wondered why the American dream of homeownership might soon become a nightmare? Picture this, the housing market, once a symbol of prosperity, teetering on the brink of a crash that could shake the very foundations of our economy. Puzzled? Intrigued? So were we. But there's more to this than meets the eye, and it's high time we dug a little deeper. So buckle up as we embark on a journey to the heart of the matter. Let's unravel the mystery of the impending American housing crash. To understand the impending crash, we must first delve into the history of the housing market. The American housing market has experienced a series of dramatic transformations since the end of World War II. In the post-war era, the market boomed, fueled by returning veterans and the birth of the suburban dream. The government facilitated this growth with programs like the GI Bill, which provided loans for veterans to buy homes, and the creation of the Federal Housing Administration, which insured mortgages and made them more accessible. However, this growth wasn't without its setbacks. In the late 2000s, the housing market experienced a disastrous crash. The bubble that had been building for years, fed by reckless lending and speculative buying, finally burst. In 2008, the crash sent shockwaves through the global economy, leading to a financial crisis that many believe was the worst since the Great Depression. The fallout was catastrophic. Millions of Americans lost their homes, neighborhoods were decimated, and the economy was sent into a tailspin. It was a stark reminder of the vulnerabilities inherent in the housing market and the dire consequences that can result when those vulnerabilities are exploited. But the market didn't stay down forever. In the years following the crash, it began a slow and steady recovery. Interest rates remained low, making it cheaper for people to borrow and buy homes. The economy gradually improved, and confidence returned to the market. By 2020, the housing market had not only recovered, but was booming once again. However, this recent boom has raised concerns. Prices have skyrocketed, outpacing income growth and making homeownership increasingly unaffordable for many Americans. The market's rapid growth has led some to fear that another bubble is forming and that a crash may be imminent. Now that we've grasped the history, we can better understand the timeline leading up to the impending crash. The signs have been there, but only if we knew where to look. Let's take a journey back in time to the start of the 21st century. We were riding high on the wave of the dot-com boom, economies were flourishing and the housing market was robust. But then, the dot-com bubble burst, and the ripples were felt across all sectors, including real estate. This was the first significant indicator that all was not well. Fast forward to the mid-2000s, the housing market was in a frenzy. Home prices were skyrocketing, fueled by low interest rates and lax lending practices. It was a real estate gold rush, but like all gold rushes, it was not sustainable. The bubble burst in 2008, leading to the Great Recession, the worst economic downturn since the Great Depression. Now let's move to the present. We're in the midst of another boom. Home prices are at an all-time high, driven by a combination of low interest rates, limited housing supply, and a surge in demand. But the echoes of the past are getting louder. So, what are the signs that we're headed for a crash? Firstly, the price-to-income ratio, a key indicator of housing affordability, is at a record high. This means that homes are becoming increasingly unaffordable for the average American. A market where prices outpace income is unsustainable in the long run. Secondly, the housing inventory is alarmingly low. This lack of supply is driving up prices, creating a seller's market. However, this could easily flip if there's a sudden increase in supply or a drop in demand. Next, let's look at the mortgage rates. They have been at historic lows, making borrowing cheap and fueling the demand for homes. But these rates are not set in stone. If they rise, it could lead to a slowdown in demand, causing home prices to fall. Lastly, the economic fallout from the pandemic cannot be ignored. Millions of Americans are out of work, and while eviction moratoriums have provided temporary relief, they are not a long-term solution. Once these protections lift, we could see a wave of foreclosures causing a glut of homes on the market and pushing prices down. But it's not just these individual factors that suggest a crash, it's the confluence of them all. It's a perfect storm of high home prices, low inventory, potential interest rate hikes, and the looming threat of a foreclosure crisis. The writing has been on the wall, but what does it all mean? It means we need to tread carefully. The housing market is a complex beast, influenced by a myriad of factors. Predicting a crash is not an exact science, but acknowledging and understanding these signs is the first step in preparing for whatever may come. It's time to put the pieces of the puzzle together. Let's start by analyzing the indicators that signal an impending housing crash. One cannot overlook the skyrocketing housing prices, which have outpaced wage growth significantly. In many metropolitan areas, housing prices have doubled, tripled, or even quadrupled in the last decade. This surge in prices is simply unsustainable. Then, we have the issue of overvaluation. A property is considered overvalued when its price is significantly higher than what the fundamentals suggest it should be. These fundamentals include factors such as the property's rental income potential, the local economy's strength, and the available housing inventory. Today, overvaluation is rampant in many American housing markets, indicating a bubble that's waiting to burst. Another red flag is the high level of household debt. The total amount of mortgage debt in the United States is now larger than it was before the 2008 financial crisis. Many households are heavily leveraged, meaning they've borrowed large sums of money to purchase their homes. This leaves them vulnerable to financial shocks, such as a sudden job loss or an increase in interest rates. Now, let's discuss the potential scale and impact of the crash. Based on the indicators we've analyzed, the crash could be quite severe. The last housing crash in 2008 led to a severe recession, and this one could potentially be even worse. Millions of people could lose their homes, and the ripple effects could be felt throughout the entire economy. The housing sector is a significant part of the economy, contributing to nearly 1/6 of the U.S. gross domestic product. A crash in this sector would lead to massive job losses, not just in construction and real estate, but also in related industries such as banking, insurance, and retail. The crash would also have a significant impact on household wealth. For many Americans, their home is their most valuable asset. A crash in housing prices would wipe out a significant portion of their net worth, leading to a decrease in consumer spending and further exacerbating the economic downturn. Moreover, the crash could lead to a banking crisis. Banks have a significant amount of their assets tied up in mortgages. If a large number of homeowners were to default on their loans, it could lead to a wave of bank failures, similar to what happened during the 2008 financial crisis. Lastly, the crash could have serious implications for the government. The U.S. government has a significant amount of its debt tied up in housing, through entities like Fannie Mae and Freddie Mac. A crash could lead to a government bailout, similar to the one we saw in 2008, which would further increase the national debt. The crash is not just a possibility, it's an inevitability, but what can we do about it? On the surface, the situation looks dire. However, there are strategies and solutions that can be implemented to mitigate the impact of the crash. But that, dear listeners, is a discussion for our next segment. Stay tuned. In the face of adversity, preparation is key. And as we delve into the impending American housing crash, the importance of strategic preparation cannot be overstated. Let's begin with strategies for individuals. If you're a homeowner, it's crucial to understand your home's value and the state of your mortgage. If you have a high interest rate, consider refinancing to a lower rate. This could decrease your monthly payments and provide some financial breathing room. For those looking to buy, don't be rushed by the fear of missing out. Remember, a house is not just an investment, it's a home. You don't want to be saddled with a mortgage you can't afford just because you feared prices would keep rising. Be patient, do your research, and buy when you're financially ready. Renters shouldn't be left out of the conversation. If you're renting, it's important to understand your rights as a tenant. Familiarize yourself with laws in your state regarding evictions and rent increases. And remember, sometimes the best defense is a good offense. Consider starting a savings fund for unexpected housing costs. Now let's talk about policy suggestions for the government to mitigate the impact of the crash. One of the key strategies is promoting affordable housing. This can be achieved by incentivizing developers to build more affordable units through tax credits and grants. Additionally, zoning laws could be revisited to allow for more high-density housing in urban areas. Another strategy is strengthening tenant protections. This could involve increasing funding for legal aid for renters, implementing rent control measures, and ensuring eviction processes are fair and transparent. Lastly, financial education should be prioritized. Many people are unaware of the intricacies of the housing market and the risks involved. By providing resources and education, individuals can make informed decisions about their housing situation. In the realm of fiscal policy, the government can consider implementing counter-cyclical measures. These involve increasing government spending during a downturn to stimulate the economy. This could take the form of infrastructure projects which not only create jobs but also stimulate the construction industry. The Federal Reserve also has a role to play. By keeping interest rates low, the Fed can encourage borrowing and investment, helping to mitigate the impact of a housing crash. These are just a few strategies that could be implemented to soften the blow of the impending housing crash. The key here is proactivity. By acting now, we can cushion the impact of the crash and potentially speed up the recovery process. The storm is coming, but with the right strategies, we can weather it. Let's not be paralyzed by the prospect of a housing crash. Instead, let's use it as an opportunity to create a more resilient, inclusive, and sustainable housing market for all. The impending crash is more than just a housing market issue. It is an economic storm brewing on the horizon, a reminder of the intricate interconnectedness of our society and economy. The housing market is not an isolated entity. It is a critical pillar, supporting a multitude of other sectors. The ripples from its fall will spread far and wide. Construction, real estate, banking, and even consumer spending all stand to be impacted. A downturn in the housing market could mean a slowdown in construction, job losses in real estate, and a potential banking crisis if defaults on mortgage loans increase. But it's not just the economy that will feel the heat. The crash will have societal implications too. Homeownership is deeply embedded in the American psyche. It's a symbol of financial stability, success, and a cornerstone of the American dream. A housing crash could shake this foundation to its core, leading to a shift in societal values and aspirations. Let's also not forget the most direct and painful impact of this crash on individual lives. Imagine the heartache of families losing their homes, the stress of individuals grappling with financial instability, and the uncertainty faced by those planning to buy their first home. The housing market crash will not just be a statistical event, it will be a deeply personal one for many. The bigger picture, therefore, is a complex web of economic, societal, and personal challenges. But let's not lose hope. History has shown us that economies are resilient. They have the capacity to bounce back from even the most devastating crashes. The key is awareness and preparation. By understanding the potential impact of this impending crash, we can take steps to mitigate its effects. Policymakers can devise strategies to cushion the blow, businesses can plan for contingencies, and individuals can make informed decisions about their housing plans. And remember, every crisis also brings with it an opportunity. Opportunities for reforms, for new ways of thinking, and for innovation. The impending crash could be a wake-up call for us to reevaluate our housing policies, to make homeownership more accessible and sustainable, and to build a more resilient economy. The American dream of homeownership is at stake, but with awareness and preparation, we can navigate the turbulent times ahead.